Blessings, 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 and good day, all. Hey, hey, hey. You're here this morning on this Sunday with Secure Your Energy Live. And yes, I'm here for it. I know it's a little dark, but just work with me, guys. Today, we haven't been going live for a while, but we're gonna get caught up because it's been a lot going on in the economy around the world. The coronavirus is out of control, politics out of control, everything is just out of control. So, you know, I've been busy myself, and also I wanted to make sure when I go live with my Secure Your Energy, it's not all like just bad juju, where you just feel like everything you talk about is like something bad is happening. But we have to be aware that a lot bad is happening, and a lot is going on that we need to be prepared for, as I said in many broadcasts, as well as start to plan for the future now, because we're in strange times. We're really in strange times, and those strange times is not can be bad or good depending on how you approach the situation and your mindset. So today we're going to go over a few videos like we always do, and we're going to basically split this broadcast into two. This first broadcast is going to be focused on some of the subject matter that I want to go over today, like the oil prices, what to look for as far as the housing market, and some things you may can do in your personal life as far as finance, because I know that we are all in a situation where our money situation is different. So we're going to talk about consolidation. We're going to talk about insurance, little tricks you can do to kind of like rob Peter to pay Paul right now. I always come up with some little suggestions because I hate interest. I hate interest myself, and especially when we're in a situation like this. We need to figure out ways that we can lower our costs. And that's called through mitigations of your bills. All right, so let's start our live broadcast today with the article. We're going to start with Channel 4 News article. Why more than 2 dozen oil tankers are anchored off the Southern Carolina coast. So let's just watch this short little video, and then we'll just review the article just a little bit. Over 200 oil tankers are floating off the coast of South Carolina in a shrinkage um, of reduced oil demand. Okay, so one of the issues is that because we're not moving around like we usually do, we're not using up the oil and gas as we usually do as consumers. So because they're still massively producing oil, just to keep production good and other reasons that we'll go over, this is causing us to basically have a whole bunch of reserve oil right now. So this is one of the reasons why um, we have these low gas prices. And I want people to make sure that they understand why. So this is a video released by the U.S. Coast Guard showing the enormous tankers legally designated for each other in the waters near the ports of Los Angeles and Long Beach. Due to the reduced demand for crude products, steams from the coronavirus pandemic, and stay home orders, the tankers have no place to be delivered. Okay? So I'll share that article with you guys on Secure Your Energy group. And we're going to go on to our first video. Here's what drives the price of oil. So I talked about one thing. It is the demand of the oil as well as the production of the oil. Let's watch this short 5-minute video and just get a little deeper insight of why is the gas prices so low. It's a good thing, but it can possibly be a double-edged sword.
From the Iran nuclear deal.
Actions
The United States will withdraw from the Iran nuclear deal.
Actions by the President of the United States can impact a lot, and oil prices are no exception. For most Americans, that means what the U.S. says and does will impact what they pay at the pump. Here's what drives oil prices. World affairs are just one of many factors that dictate oil prices. If you're in the world of oil, monitoring the ebbs and flows of crude prices is second nature. Most investors either follow WTI or Brent crude. Brent crude refers to oil from certain oil fields in the North Sea, and it's used as an international benchmark for oil prices. And West Texas Intermediate is one type of light crude that's drilled in the U.S. and serves as a benchmark for U.S. oil prices. If you're not an oil analyst, it may seem like a lot to keep up with. But regardless of which of those contracts you follow, the gist is the same for both. Oil prices are influenced by three major factors: supply, demand, and geopolitics. Supply and demand just has to do with how much oil is available and how badly people want it. Supply has historically been determined by countries that are part of the Organization of the Petroleum Exporting Countries, also known as OPEC. But now, the United States is playing a bigger role in supply thanks to the booming production from American shale fields. So, if major oil-producing countries are pumping out a lot of oil, the supply will be high. Just look at what happened in 2014.
At the OPEC meeting in November, Saudi Arabia made the decision that they were not going to cut back production. They were going to continue to produce at record high levels. At the same time, you had very robust output from the United States and from other producers around the world. It was more oil than the market needed.
Oil prices crashed as producers pumped more than the world could consume. OPEC was largely blamed for the free fall in oil prices because it refused to cut down its production. But OPEC said that U.S. shale drillers were to blame for pumping too much and that they should cut their production first. In 1973, Arab members of OPEC put an embargo against the United States as a retaliatory measure. After the embargo, the oil supply in the U.S. was so scarce and the demand was so high, it drove the price of oil to the point that gas stations began rationing gasoline. Demand, on the other hand, is determined by how much need there is for oil at a given time. Think of the need for things like heat, electricity, and transportation. The more economic growth a region sees, the more demand there will be for oil. And then there's the question of how the market will react to renewable energy.
A lot of this will be impacted by public policy, but at the end of the day, renewables can only displace hydrocarbons if it's economically feasible. Right now, renewables are still more expensive than hydrocarbons, so consumers aren't going to voluntarily make this switch.
Geopolitics. Remember how supply is determined by the big oil-producing countries? Well, if there's tension with one of those countries, like a major war or conflict, it could throw off the supply of oil, which would then alter the price of it.
Particularly when situations in the Middle East or other oil-rich regions of the world would flare up and there would be conflict, you would generally speaking see a little bit of an uptick in the price of oil as a result, just by virtue of the risk of supplies being disrupted or of means of transportation being disrupted, such as canal or pipelines or workers going on protests, things like that.
Just think back to 2003. After the U.S. invaded Iraq, oil prices went up. And with instability in the region, people weren't immediately sure what would happen to the supply. More recently, President Trump pulled out of the Iran nuclear deal and restored sanctions on Iranian oil exports. Oil prices hit 3.5-year highs as traders tried to figure out how the sanctions will impact global oil supply.
That's what makes the oil market so fascinating, is that it's really a very interesting interplay of financial markets, the economy, and those are two very different things, the currency markets, geopolitics, and the environment.
The energy industry is sure to evolve, and it remains to be seen what role oil will play in the future. But for now, the oil markets remain a powerful force in the world of economics, geopolitics, and your commuting budget.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC.
So y'all know that was CNBC. I always share wherever the resource came from. Most of the videos are shared on YouTube, so y'all can go back and find these channels yourself if I don't share them in the the Secure Your Energy group. So a few things that highlighted in this video, which I started talking about prior to the video, is some of the factors that actually weigh in on the price of oil and gas, crude oil, and that is supply and demand. If we actually do need it at this time, as well as geopolitical in most of the topics that we talk about, especially when it deals with trade, definitely political environment plays a role in everything. It plays a role in every aspect of our current economy, health situations, stock market, trade. So geopolitical is very important, and perspective of leadership and governments plays a role in interactions with other nations. So, one of the things that she did mention, for instance, um, when they were saying that basically when it's competition between industries or governments, this is basic can be reflected in higher costs because of risk factors of their competition or their disagreement or agreement. It weighs in on the people, so they have to have some type of buffer to make sure that they're insured and they're receiving the monies that they need to receive. Just as an example, when your insurance rate will go up. Sometimes, like a couple of years ago, when the Hurricane Harvey thing went on, and my home insurance went up, and I'm like, why did my home insurance went up? They supposedly said, because of the risks in other states, because of other things that went on pertaining to that hurricane across the board, we were affected. And this is how these capitalistic agencies does things. They don't want to lose, so we end up all paying at the end of the day. So some of the companies that you want to pay attention to when you're reading articles and seeing how they're doing is the Texas industry, because that deals with United States oil production and distribution to us. How well they're doing, what's going on with them, as well as pay attention to Brent crude oil. That's an international distributor as well. And all of these people become companies end up being in competition, and we, the consumers, are the one that kind of pay the price, reap the benefit, or reap the non-benefit of it. So right now, things okay because the price of gas is lower. We don't have as much income coming in as people who are prompted to stay home because of the COVID virus, and many businesses shut down. So we're going to talk about that as well today. But I just want you to understand why our oil prices are low and the different factors that play a part. So it wasn't just the coronavirus as well and stopping the production of it. It is actually the relationships that our government have with these other nations that control crude oil or distribute to us, because you can only get so much from a Pacific industry or a Pacific buyer. And it's always good to keep your basically keep your portfolio diverse when it comes to who you buy from, and when it comes to numbers and competition and getting the best things out of life. You know what that means, especially if you're a business owner. So another factor that was very important that they talked about too, to consider right now with the oil prices and how we have so many tankers just sitting there in the Gulf, or outside the coast of Los Angeles and in South Carolina, is renewable oil. Reusable energy. Do apologize. This is something that has been pushing most recently, and I definitely know, being a Jersey native, that I was still receiving a lot of information pertaining to solar programs out there in Jersey and Maryland, and it really pushing to kind of transfer us over to more efficient energy source. So those are the things that we got to keep in mind at this time. It may happen. It may happen because this is the best time for transition. When it comes to destruction may not always be bad, because it always can be rebuilt fresh and new. Just to have an open perspective, to not just look at, oh shit, things are crashing, because I'm going to tell you about some, accounts that I had to move around, just feeling unsafe because seeing money being lost in it, So let's move on to the next video this morning. I hope y'all doing well this morning. I did miss being live with y'all, on Secure Your Energy, but I just wanted to make sure the vibe was right, and I usually just come on when the Most High say, just get on there. So I had some content already set up for y'all, but I just wanted to make sure that the feeling was right. So what do low prices, gas prices mean? This is just a short 2-minute video we'll watch and just get another perspective of what it means for the economy, and as well as what it means for the people. What does it mean? What can we possibly expect may happen when things go back into normalcy? Will the gas prices just shoot back up, and will we be ready for it to shoot back up? Because most most likely at that time when things start to go back into normalcy, people go back into work, they're going to have a lot of bills to catch up on, because a lot of them are in deferred payment, as well as some companies have not actually, taken the payment away. They just pushed it back, so people who rent, they'll probably end up having to pay 3 months of rent, depending on how the landlord wants to, deal with the situation. So that has to be taken in consideration when things go back to normal or go into another stage, because I don't think we'll ever have what we had before. We may have better if we know how to approach this situation. And that's why we do these Secure Your Energy lives, because us as individuals have to fix our household, have to fix the way we approach the market. And we are the ones that actually literally control the market, our spending habits. This is why, my opinion, they prompted a lot of people right around the time of the stimulus checks to come out now for supposedly, governors to open up the states, being prompted by the federal branch at one point, and then the next day being, criticized, saying, "Oh, you opening it." But what that goes to say, I just think that was more so a step to get the economy moving. At the end of the day, to get people spending. So we do have to pay attention to the tones and situations of the whole environment. Let's watch this video together.
Oil prices neared December 2008 lows this week as traders saw no sign of an end to a persistent oversupply around the world. Global benchmark Brent crude and the US marker West Texas Intermediate have tumbled since the meeting of OPEC ministers at the start of the month, and both are now hovering around $37 a barrel. Discord within the group about which members should cut production to shore up the oil price has led.
So I just want you to be mindful that this video took place in December 2019, before the COVID was told to the people that it was here or going on in China. So just be aware that these oil changes in the prices has been happening. So that's one of the things I really want to highlight. All the market changes and things that's going on, we should not just blame it on COVID. It's been going on for a while.
To a continuation of OPEC's existing policy to keep on pumping. Although production growth outside the cartel has slowed dramatically amid low oil prices, OPEC producers have increased output. The scrapping of the group's official ceiling this month took away any pretense of production constraint, adding to the bearish sentiment in the market. Although cheaper oil is a boon for consumer countries, from the US to the UK and China, a prolonged slide is detrimental to producer nations, for example, Venezuela, Nigeria, and even financially stronger Gulf economies such as Saudi Arabia. At the same time, the oil price collapse has battered the balance sheets of the world's biggest energy companies that have been forced to slash hundreds of billions of dollars in future investment and cut thousands of jobs. Energy stocks have been hit hard too by the oil slump. Highly indebted US shale drillers and the banks that lend to them are also suffering, with much of the junk bond energy sector currently in distress. Bankers in the US say they are cutting the borrowing limits of exploration and production companies by as much as 20%, as the value of their reserves have fallen sharply. There is a concern a lengthy period of cheap crude could trigger widespread defaults. With crude inventory set to rise even further over the next year, as storage facilities on land reach tank tops, oil analysts are finding it difficult to be optimistic about the price.
Okay, so as she said, she gave some more factors to pay attention to. But one of the things I want to highlight that she did mention is that, the value of the oil or the crude oils that's sitting there plays a big part on how our economy possibly will take off when it comes to crude oil. If it's so much crude oil there, obviously the supply and demand is still going to be off balance, and at the end of the day we may be able to maintain lower oil prices for a little while until we balance out, or because of the capitalistic view of things, once people start to want oil, regardless of how much reserve they have, they're going to up the price, you know. So it's two ways to kind of look at this, you know, and then they have all this daggone reserve oil, and we stuck with a high amount of, you know, purchase price, because right now it's a high demand. Even though they have a lot of supply, it's a high demand. So that's kind of how we got to be open to looking at economy and how different capitalistic companies may approach situations so we can be prepared, you know. And that may prompt people who use a lot of oil, a lot of gas, you know, maybe working on farms or whatever industry that they use it for. It may prompt them to, you know, get a lot of oil now, a lot of gas now, and kind of hold it until see what happens if the market like sharply change, and at that time it'll really hit their pockets. So that's why we have to pay attention to the trends. So, you know, people who are in the industry that's using crude oil, this may be the best time to kind of stack up on crude oil, not knowing specifically what's going to happen to the market and the fluctuation of price. At one point we're going to have to start moving, and we haven't totally converted over to like solar panels or energy efficient products such as cars, housing without oil, you know, things like that. So we're going to still need this product. So that's kind of what you may want to pay attention to. I'm not a person who invests in stocks, but, you know, people who want to play Russian roulette with the stock market, we talked about how sometimes it could be rigged, because I'm going to keep it real. We talked about those high frequency trade-ins. But if you know how to deal with it and you're able to work as your own stock broker, and you understand without the, you know, all extra fees and stuff, you may want to look into that. So the next thing I want us to look into as well is because the housing market. That's very important. We have a lot of homeowners, minority, non-minority, new homeowners, and, you know, people who've never been in this situation, and they never plan on not being able to pay their mortgage. You know, so we're going to talk about some things, maybe some options we may have as the general public, you know, and, you know, communicating with these mortgage companies and seeing what they're actually doing for you, and what is your state regulations in regards to what they can and cannot do to you in the midst of like the coronavirus. So 10 signs of housing market crash 2020, the worst real estate crash since it's supposed to be 2008. I'm just going to try to get the date of this video. I think it's most recent. Yeah, it's April 15th. Epic Economist, that's the channel. So if you like the content, definitely check it out. So we're going to watch a majority of this video, and let's get started.
People believe the health crisis will soon disappear. Others can be overly anxious about how long it's going to last and how deep the consequences of this outburst could hit them. A number of Americans are already feeling a hint of the weight of this economic crash on their backs. And in this video, we're going to assess the imminent real estate crash that is concerning many of them. The stock market crash has made investors and home buyers discouraged and wondering if the housing market isn't the next piece in this domino effect fall. As stated by a survey done in April by the National Association of Realtors, 90% of their members affirmed the current outbreak has considerably decreased home buyer interest. More than half of the clients decided to postpone their purchase until the situation calms down a bit more. 2/3 of them are expecting lower prices. According to a recent publication on the Balance's website, there are 10 warning signs that can help you predict an incoming crash. Using this list as a base and adding guidance from the data we collected from renowned web portals such as Investopedia, Rate Hub, and PR Newswire, we are going to explain how every one of these aspects can contribute to a collapse in this market on a greater to a lower extent. Asset bubbles bursting. Now, usually crashes like that take place when an asset bubble bursts. A red flag for an inherent bubble is the sudden boom in home pricing. On the authority of the Case-Shiller Home Price Index, by January 2020, the national average home price hit a record high of $212,433. That's 15% higher than July 2006 record.
Bear with, my internet is trying to play catch up right now.
High of $186,613. Likewise, the S&P Home Builders Select Industry Index has climbed drastically from 1,372.6 in October 2011 to 4,867 in February 2020, setting a 250% raise. However, it has dropped by half to 2,486 in March 2020. James Stack from Stack Financial Management declared in an interview with MarketWatch that he used the Housing Bellwether Barometer to predict the 2008 financial crisis. This is an index he created to assist home builders and mortgage companies. In 2017, it skyrocketed just as it happened in 2004 and 2005. Increase in unregulated mortgage brokers. As it's affirmed by RateHub website, the regulated mortgage market is constituted by bank and monoline lenders, which are federally regulated. Regulated creditors are supervised by the Office of the Superintendent of Financial Institutions, OSFI, so they must follow the rules established by OSFI. In contrast to the regulated mortgage market, the unregulated market is made of mainly by private creditors that can be companies or individuals that are out of the reach of the national banking regulators. Private lenders offer
So while that play catch up,
where is the best place to get leads online?
I want you to just pay attention to
for your business. Is it YouTube, Facebook?
Is happening. One of the things is that you have to understand there's two type of lenders when it comes to housing markets, and we have basically unregulated lenders and we have regulated lenders. So we're going to talk a little bit more about that too as well next week when we go into primetime home buyers, so you can understand the significance of stepping into getting tax liens versus dealing with loans. Okay, so I just wanted to highlight that something very important. So learn about or keep in mind unregulated mortgage lenders versus regulated mortgage lenders. They have different people who they report to. Okay, we'll talk about that in weeks to come. Reporting agencies and things like that, because I also have some things that I've been reporting most recently, questioning some of the practice of some of these big name corporations. I'll leave their name out right now, but you know, you on my personal page, you will be seeing lawsuit filed, complaint filed, because you know that's what I do. I'm not going to let no one take away from the little guy. And if I could show you what I do to kind of get these people put on blast, you know, and ask these questions that need to be asked, then just inbox me. I'm here for it. So let's watch this together.
Offer higher mortgage rates than conventional lenders, usually short-term loans at rates above 7%. Usually, people turn to private lenders for short-term mortgage loans if they can't normally qualify with banks or alternative lenders for the A or alternative mortgage space. Currently, it's become more important than ever to address the sudden growth of the unregulated mortgage market. It's harder than ever to qualify for conventional mortgages due to the increased mortgage regulation. As a result, more people are turning to the unregulated mortgage market, and their loans are becoming pricier and pricier. In 2018, they generated 53.6% of mortgages in the United States. 5 of the top 10 mortgage lenders aren't banks anymore. This can make them more vulnerable to a collapse if the housing market crashes again. Rising interest rates. Generally, a slow and steady interest rate increase won't create a catastrophe, but a sudden boom in rates is more likely to do so because higher interest rates make loans more expensive, and consequently, it slows home building, decreasing its supply, and also slowing lending, which reduces demand significantly. The Fed has lowered interest rates to 0 to assist business owners with the economic crisis, and that should help the housing market too. But if we analyze how interest rates have been rising preceding the housing collapse of 2006, when many borrowers had interest-only loans, and adjustable rate mortgages, and many also had introductory teaser rates that reset after 3 years. When the Fed raised rates at the same time they reset, borrowers found that they wouldn't be able to afford the payments anymore. Home prices had dropped. Mortgage holders couldn't pay for or even sell the house, leading to huge default rates. This showed us the Fed raised.
Okay, so I just want to highlight, because this kind of like a long video, so I want to just highlight the key points that were just made. So there is unrestricted or unregulated loan companies, or pools of private investors that come together. Like for example, Prosper Loan. Loan is a private loan company that is like shareholders or people who pulling money together to let the person who possibly don't have the best credit, or a situation that's a little bit, that makes it harder for them to get a conventional loan. These people usually go that way. Another example, and this is just like a brick and mortar example, where they say titles for sale or something like that. We'll buy your title, so they will give you. There's a lot that goes on down south too, and I really don't recommend you guys to give these small loan companies your title for your car, knowing that you may not be able to pay it back. I think that is wrong. I think it's a setup. As well as what he mentioned is that these unregulated companies have more room to make predatory contracts. That's why it's very important for us to learn contract and read the specifics of contracts and how they set up different loans and mortgages, insurance policies, and everything. You always have to take your time and read it. I know it's not easy, especially when it's time for you in the middle of closing on a loan, and then you got all these papers that the lawyer's saying, sign here, sign here, sign here, sign here. So that right there is very hard to do. On later dates, we'll talk about that, different ways you may want to protect yourself with your signature. Just indicating that you don't totally understand everything. It's kind of like cohorting you to sign a one-sided agreement. So we'll talk about that on later dates. But you have to pay attention to those type of things that happens with loans, and that's at the tone of it right now. Also, the regulated industry has taken a big hit as well, because when our new administration came into the office, they dismantled Dodd-Frank, and we talked about the Dodd-Frank Act, the Housing Act, that was supposed to regulate predatory banks and practices, and basically just giving loans to everybody and then putting them in crazy situations, such as what she said. You'll be in an introductory rate, and if you don't lock it in or know to lock it in for your full term mortgage, reading it, because they can put the verbiage in there that you're locked in for 3 years. And then 3 years, you have low interest rate, as you mentioned, from the feds that's coming in. And then you have low interest rate from what you set. But then after that 3 years come, then you have an increase of whatever the Fed interest rate, because that's the base interest rate, and then the interest rate that private entity wants to charge you, or based on the market, and if you're not too savvy about the market and how they make these decisions, you may not know how much your interest is going to increase in 3 years, and change the actual mortgage agreement and the payments possibly. So please be aware, especially in the housing market that we're in right now. The housing market, the advertising market, I'm just saying, it's dangerous. It's dangerous for the average person who don't read and don't understand. I'm going to be honest, because some of the things that I have seen in some of these agreements, and I'm like, wow. One of the main things before I start this video back is when you're opening a loan or a mortgage, they have this clause in mortgage, and we're going to talk about it more in detail. The name slips my head right now. But basically the clause, it highlights that if you default on your payment, or you try to transfer the property into a trust, or certain things happen while you have the home, that they can demand full payment. And that was one of the things that I do believe, but you can correct me, was regulated by Dodd-Frank, because you have to have some time for mitigation. You have to have some time to allow the person to get back on their feet and things like that. So I did come across an article a while ago of a lady who owned a building in some urbanized area, and it seemed like they really wanted the property back for some apparent reason, and she may have missed a loan payment or something mixed up with taxes or something. And what that goes to say, they moved in right away to demand her to pay the whole mortgage off, which was virtually impossible, which put her in a situation to have to hurry up and sell the property and or lose it. You see, so these are some of the things that we have to pay attention to. You know, new home buyers who's new to the market, people who want to jump in the market because they're looking like, hey, the interest rates are low. You know, the Fed's got it low. They're trying to pull you into the situation. They have all of these gimmicks or, you know, introductory sell gimmicks. I'm going to just say it to pull you in right now. Like, hey, no money down, no this. We know it's a COVID. And then you get into a situation and you're not really financially stable to be there. So this is like a full view of predatory loans, you know, and things to kind of look at when you're looking at unregulated loans and regulated loans. If people didn't know there's a difference, there's a difference. You can go to the private sector and supposedly you could go to public sector. You know, at the end of the day, you both dealing with businesses that's privately owned that wants to make money. So you as the consumer has to be very aware of what you're signing.
Rates too fast between 2004 and 2006. The top rate was 1% in June 2004 and doubled to 2.25% by December. It doubled again to 4.25% by December 2005. 6 months later, the rate was 5.25%. Since 2015, on the other hand, the Fed raised rates at a much slower pace. Moving on to inverted yield curve. Another warning alert for the housing market is when the yield curve on U.S. Treasury bills reverses. An inverted yield represents a scenario where long-term debt treasuries have lower yields than short-term debt treasuries of the same credit quality. As it's explained by Investopedia, a yield curve is a...
Wow, it gets itself together. You also know that in earlier broadcasts, we talked about the inverted yield curve, what the yield curve is,
I'm sure you've heard the news about the government sending out rebate checks. Any single person...
And you can find that in Secure Your Energy, actually, YouTube page. Go back down into the titles and you'll see what's a yield curve, like what it means to you, what it means to the stock market. So you can kind of get an idea of what's a yield curve if you don't know what it is. Deal with the process.
Graphical representation of yields on similar bonds across a variety of maturities, also known as the term structure of interest rates. Normal short-term yields are lower because investors don't require a high return to invest for less than a year. When the yield curve inverts, short-term interest rates become higher than long-term rates, which means investors think the short-term is riskier than the long-term. This type of yield curve is the least common of the three main curve types and is used as a way to predict an economic recession. Now, the yield curve inverted before the recessions of 2008, 2000, 1991, and 1981. Due to the unusualness of yield curve inversions, they normally draw attention from all parts of the financial world. Changes to the tax code. The real estate market tends to react assertively when Congress changes the tax code. It's said that Trump's tax reform plan could have a negative impact on housing. The real estate sector is opposed to this tax plan, which raises the standard deduction so that many Americans no longer need to specify. Consequently, they can't take advantage of the mortgage interest deduction. Banks return to using derivatives. Economists alert that the real estate market can collapse if banks and hedge funds return to investing in risky financial products. These derivatives were one of the main causes of the financial crisis, you may remember. Banks had cut mortgages down and resold them in mortgage-backed securities. These bonds were a bigger deal than the mortgages themselves. Then, banks sold mortgages to literally anyone because they needed derivatives to be supported. They cut them so that bad mortgages were hidden in groups with good ones. Therefore, when debtors defaulted, all derivatives were suspected of being bad. And this very episode led to the disappearance of Bear Stearns and Lehman Brothers. Increase in flipped homes. Almost 6% of all home sales were bought for quick resale at the end of 2019, differently from the post-recession high of 7.2% on its first trimester. The so-called flip homes were meant to be purchased, rehabbed, and resold in less than a year. Todd Tater, Chief Product Officer at Atom Data Solutions, reported that home flipping profits across the U.S. dropped again in 2019 as the business of buying and selling houses absorbed its worst year since the housing market was mired in the fallout from the Great Recession. This happened as the cost of buying properties continued to rise faster than gains on resale, which made clear for realtors that this dramatic downfall is a sign
it doesn't.
that the housing boom may face a countdown. Affordable housing plummets. In addition to all
I'm sorry, guys. We're having so much internet issues right now.
these factors, there is an ongoing fall in affordable housing. Cities are having the worst shortage due to soaring home prices. Between 2012 and 2017, housing costs have increased by 30%, while wages have only risen by 15%. By the
Okay, so we're coming down to the last few minutes of this video. Before we go get the last hurrah of this video, I just want to highlight some key things that he said in this video. So we have to understand and review the tax codes that Trump has put in and how it actually affects us when it comes to, you know, our standard deductions versus itemized deductions, because we went over a little bit of that when I did a little, probably like an hour video on, you know, paying attention to your tax deductions for businesses, just kind of introducing that information to business owners who don't know how to do their taxes but may want to talk to their tax representative about certain information. So you can find that video too on Secure Your Energy YouTube page. Another thing that he mentioned and that y'all have to be aware of is when we talked about the housing market crash in 2008 and how it actually transpired too. It transpired because things was unregulated. This was prior to the Dodd-Frank Act. And, you know, they were basically combining loan agreements into packages called ETF, and these ETF were basically smaller instruments that they were selling to private investors, hiding the risky loans with the good loans and basically trying to make sure that they ensure that they make some type of money off of it and get some money back. So those ETFs continue to be sold between investors and investors until they couldn't be sold no more, but when people realized that it really wasn't worth nothing, and you had a lot of people who were defaulting on their loans in those packages of having 6, 7, just example, housing mortgages in there, and you have 5 of them that can't pay their mortgage because of the predatory loan agreements that they actually put these people in. You have to understand that people are going to try their best to have home, and they're going to try to live the American dream. You know, so if you give them an opportunity, they're going to be like, hey, we could try to make this happen. So it's at fault of both the individual and the banking system, but that's why we have to psychologically approach these situations and really know what's going on and make mindful decisions on the individual level before we get caught up in the heist. Because it ended up being straight a heist. And what ended up happening, more of our money that we did pay in tax or whatever we could do has been reallocated through the bailout, through these same companies who were practicing like this, doing these things. And that's where people really feel away. So just pay attention to those things, the ETFs, and how these things are starting to reoccur again because, you know, our current administration have deregulated the Dodd-Frank, as well as, you know, they talked about a lot of having like free market, you know, businesses should be able to make their own contract. Deregulations, that was one of the main points of electing this government entity for that election to some people was because they were business owners and they wanted to be able to deregulate their contracts and say what they want and kind of entrap people into loan agreements that they may not be able to, know or control. Also, 2019, as of 2019, he mentioned 2019, okay, that's not a long time ago, that basically there's been an increase in flipping of homes. So this is some of the things that we're going to talk about on Primetime Home Buyers, where it is a risk factor to have homes right now, but I definitely think it's more of a risk factor to have loans, have homes with loans. If you have property that you can obtain without home loans and possibly just have to pay tax on the property and insurance until this market seems to thin itself out, it's kind of a titty-tot of balance of touch and go, but you'll have more luck and less expenditures if you go that route than still trying to flip houses and buy houses at $30,000 and then you can't sell it, where you possibly can go another route. I am giving an advertisement for Primetime Home Buyers and, foreclose via tax liens and help the tax possibly help the homeowner stay in the home, but you'll end up having a property that possibly already have a tenant in it, or possibly have someone who wants to lease to buy again, that you could work an agreement out. So it's so many different ways, we can approach this mortgage issue without being caught in the rigmarole of all that we've been talking about, all of the interest, the ups and downs, what may happen in 3 years when you're not in a fixed interest agreement with your loan company. It saves you a lot. So I know I went off kind of a little bit, but this all plays a part together. So today we just suggesting some ideas, of ways that we can kind of prepare for this roller coaster ride. We're already in. We can't be prepared. We buckle up. Just buckle up, Bucky, on this roller coaster ride, financially, emotionally, spiritually, health-wise, what's going on. But at least if we start to focus our energy on something, on potentially new and better outcomes, we'll possibly do a little bit better when it's time for the transition.
Only 39% of rental units in the U.S. were affordable for low-income households. That's a 55.7% drop compared to 2010. The city population has climbed by 14.5% between 2010 and 2019. Now, that's a lot faster than the national average of 6.3%. Rising sea levels. A collapse is predicted to happen for real estate markets in coastal regions that are susceptible to the impacts of rising sea levels. It's estimated that by 2045, approximately 300,000 coastal properties will flood at least 26 times per year, summarizing a total cost of $136 billion in real estate. This can interfere in the valuation of 30-year mortgages that are being made right now. Experts believe by the end of the century, 2100, 2.5 million homes worth $1.07 trillion will be at risk of chronic flooding, and properties located on both coasts are at most risk. During high tide, the streets are flooded by the ocean in Miami. According to a Harvard survey, house prices in the lower areas of Miami-Dade County and Miami Beach are slowly soaring in comparison with the rest of Florida, and properties at risk of rising sea levels are sold at a 7% discount to comparable properties. The Balance's article claims that most residencies in these cities are financed by municipal bonds or home mortgages. Their destruction would definitely hurt investors and depress the bond market that could lead to a real estate collapse in these regions, especially after severe storms. Finally, officials warn of a housing crisis. William Poole, the former president of the Federal Reserve Bank of St. Louis, warned in an editorial of 2017 about another subprime crisis. Poole was the head of the Federal Reserve Bank of Kansas, who warned of the subprime crisis in 2005. He says that 36% of Fannie Mae's loans required mortgage insurance, a similar rate from 2006, which indicated that the recession was about to come. With this list, we can see from many different angles the possibility of a real estate crash sometime soon. All the conditions seem to be adding up to an eruption on many fronts. There is another outburst, about to form.
All right, guys. So I'm going to give y'all the YouTube channel here, and I really appreciate his commentary. One of the things that really stood out to me that I didn't think about was actually the rising sea levels. It really plays a big part on insurance, property value, and the value of rebuilding the property. And like he said, over a 30-year mortgage, if you have a property that's at risk for being flooded out because of the change of environment, this is the natural change in environment. Some people don't look into this, but what I have learned, I think I mentioned this, getting a little geeky a few lives before, about reading an article basically saying the rise in sea levels is not really due to global warming per se, but it's also due to a primary factor of the changing of the shift of the tectonic plates. We have different layers of the earth, breaking it down, different layers of the earth, and they're shifting. So when you have one plate going this way and you have another plate going this way, and actually the level of the sea higher and towards the coast. So that's why they're saying slowly but surely that the our sea level is increasing, because it's the shifts that's going on under in the earth. So that's something to really pay attention to. People don't really look into that stuff, but please keep your eyes on the prize. It's real. Let's move on to our next video. We probably just have 3 videos. I don't think they're too long. And then we're going to stop the broadcast and we're going to go straight into our gold. Our gold session, all we're going to talk about is gold, what's going on in the gold market. We're going to be talking to you guys, new Secure Your Energy team members who signed up in the last couple of weeks. Thank you for signing up. I have seen your emails, and I hope that you got my emails back, showing some of the resources for you guys to try to, enlighten as many people as possible. Also, gain some free gold. You never know. You never know. So Fed just responded to the 2020 mortgage and housing crisis. We're just going to watch about 5 minutes of this gentleman commentary. I found him a little bit interesting. Meet Kevin. So you let me know how you feel about him. And if you like his commentary, definitely check out his YouTube page. We're going to have to tell people to meet me outside. Just meet me outside.
News update from the Federal Reserve and the Federal Housing Finance Agency on what's going on with the crazy and evolving mortgage crisis and possible housing market crisis to follow. Let's get into that on today's Meet Kevin Report, where I report news that makes you money. As of last week, almost 6% of individuals, 5.95% of mortgage holders, have entered into forbearance agreements, agreeing not to make payments for the next 3 to 6 months. We've also seen that a lot of those folks entering into mortgage forbearance agreements are seeing their credit scores plummet by ranges from 30 points to 50 points to 75 points, as credit bureaus are picking up on notes that say, sorry, your account is in forbearance, and the credit bureaus don't like them.
So that's the heist, y'all. I'm just saying, we needed the forbearance. There's a lot of people who needed that, but I'm telling you, that's the heist. That's how you get set up in certain situations. I wouldn't even thought that the credit bureaus would respond in such a manner. So I just want y'all to be, highlight that. That's just wrong. That's just wrong.
That all of these things are combining to start making a lot of us feel a little bit worried about real estate. After all, when we look at new construction housing starts, we see they've plummeted to record new lows. We see sales volumes declining 20 to 30% in the first 2 weeks of April across various different parts of the country. However, prices are tentatively remaining stable, at least when we compare pricing today to pricing in January in many markets across the country. We see pricing relatively flat, which is a good sign so far, but what does it mean for the market to come? And what is the Federal Reserve and the Federal Housing Finance Agency doing to minimize the damage? Well, in order to get a glimpse of what the Federal Reserve is thinking, which remember, the Federal Reserve puts data together and they give that data to the government so the government can decide what do they want to do to help people like us and what's it going to mean for housing prices. Well, the Federal Reserve Bank of Richmond yesterday published a briefing that said, all right, let's run some projections. Let's say that unemployment stays at 20% throughout 2020 and into 2021. If that happens, the Federal Reserve Bank of Richmond thinks real estate prices, without intervention, will fall by 15% through 2025 and will then rebound. This is one of the most dark and dire projections we've seen yet. Well, so far, we've seen that Freddie Mac thinks prices will actually be relatively flat, positive 0.4% and 0.7% in 2020 and 2021. But the Federal Reserve Bank of Richmond is looking out at the long-term consequences of what this Rona crisis and high unemployment might actually cause going into 2022, 3, 4, and 5. And look, 15% isn't as bad as the 25 to 35% declines we saw during the Great Recession or the 45% declines we saw in commercial multifamily real estate during the Great Recession. 15% is still bad. And using 15% as a price decline, the Federal Reserve Bank of Virginia found that, all right, we might, in a favorable case, see losses in excess of $420 billion if prices decline 15% after these mortgage forbearance periods. That's a lot of losses. In fact, I'm going to compare these losses to Chase to kind of make us be able to picture these a little bit better. Their base case scenario was $580 billion in losses, and the severe case showed $1.1 trillion in losses if prices decline 15%. Which, just to compare these losses so we can kind of predict how bad the mortgage crisis would be, it's helpful to compare these losses to Chase and their share of the mortgage market, which, don't worry, I ran all those numbers for you. I looked up their annual reports, their net income and consumer banking, all that. Bottom line is, if these losses happen, Chase Bank would basically be working for free for consumers between 6 months in the favorable case and up to 24 months in the severe case. Working completely for free. That's like, no, revenue didn't go down 10%. That's working for nothing for the next 6 to 24 months. So this is bad. And that's only referencing Chase's share of the mortgage market. If Chase lost somewhere between $8 to $30 billion in mortgage losses, yeah, they'd be working for free in consumer banking for 6 to 24 months. That's really bad. But think about this. Over 60% of mortgages are actually originated by companies like Quicken and Mr. Cooper and other online non-bank mortgage brokers. So they would be suffering pretty substantially as well. Fortunately, though, the government is responding finally to the growing mortgage crisis. But to understand how the government is responding, let me give you this quick primer here. This is you and me. When we stop making our payments, that is, we do not send the bank our money, and that does not happen, the bank still has to send these rich bondholders money. And they have to do that forever until they basically write this loan off the books, which basically means taking a loss on this and writing it off. They keep paying the rich dude. Well, this is a lot of money that banks have to keep paying the rich dudes, and that's why the banks are trying to screw people's credit for asking for forbearance.
Okay, so you see what he said? Just know that the rich dude is the people who are investing in the ETFs, okay? That's the rich dude that always supposed to get paid. They get paid in the end. So this is the connection. I really like this guy. I really do.
We want less people asking for forbearance. It kind of makes sense. Well, finally, we've had the government swoop in and go, don't worry, we're here to help. And so they said, no worries, you're only going to be required to send money to the people who hold those mortgage-backed securities, the rich dudes, for 4 months. After the 4 months, we will pay the rich dudes. This is really, really good news for 2 reasons. 1, it limits losses at banks, which when banks have less losses, it means they keep credit flowing. It means they don't necessarily tighten their lending standards, even though a lot of them already have. They might relax those standards again, and it also means they might freeze less credit lines, and anytime banks keep their lending guidelines looser, it means we have more money to be able to borrow or build businesses with or finance investing activities or whatever with, so that we can actually grow the economy. So even though this kind of seems like a bailout, I mean, that's kind of exactly what you could call it, a bailout, it allows the banks to be looser and less restrictive with us. Hopefully it also means they're going to stop screwing our credit for asking for forbearance, and we in turn, since we make up 70% of the market as the consumer, we're the ones making up 70% of the market, not them, then hopefully we can get the whole engine moving smoothly again. So this is a really, really good thing. This is the government coming in saying we do not want to see 15% declines in real estate. In other words, it's not fair to say, hey, let's crash real estate because this unforeseen pandemic happened that made 20% of people lose their jobs like overnight, and now banks have to tighten up and start freezing their money and increasing credit requirements. They're trying to resolve that, so this is good news. But the good news actually doesn't end there, because Fannie and Freddie and regulators are actually in talks to do something that hasn't been done for quite a long time. Fannie and Freddie are in talks to potentially buy homes directly from people in mortgage forbearance. That is,
now, I'm going to let y'all finish watch this video for yourself. I will put it in the Secure Your Energy. That right there, I'm just going to stop right there. I don't know if that's totally a good idea, because it depends on who owns Freddie Mac and Sallie Mae, the same companies. Sallie Mae is the student loan. Who owns Freddie Mac and these large companies that plan on buying the homes, meaning that they're going to plan out own property out here in the United States, even if they're foreign entities that are invested into these ETFs. So just let's us make sure that you think outside of the box and you pay attention to everything that's going on. This guy is very, very, very good when it comes to his perspective. I really like it. So I'm going to share his page with you guys on Secure Your Energy right now group, and then we're going to move on to our next video. I'm just going to do it now, because if I don't do it now, then you may not get it. I'm just playing. Y'all know I post all the time. So let's move on to the next video. I hope y'all enjoying the broadcast, that y'all getting a wider perspective of how to kind of look at how things are going right now. And we're going to move on right after these two videos on just some measures that I had taken to try to ease the pressure, of this situation, and make sure that my health and my family health is the first important aspect to focus on before I make any money moves. And I hope that you're doing the same thing right now for yourself, because the severity of the COVID virus is questionable, based on new findings, numbers, testing procedures, in certain people's eyes. But as I mentioned, this is a very deadly and is a very contagious virus that I have seen, up close and personal. And just know, if you get sick to the point that you have to be hospitalized, or even take care of yourself, or can't go to where you need to go to make money, you're going to lose. You're going to lose. So please take this time to make sure that you are considering your health before you do any money moves. It's very important. I think that's the most important thing. So let's move on to this video. How the coronavirus impacts gold prices and demand. So this is, I think this video is actually supposed to be here. That's supposed to be our introduction to our part 2. So you see me coming down to the wire. I think this is the video that's supposed to end off part 1. Let's recheck it. Thank y'all for having patience with me. Y'all know I'm my own producer. And I shout out to Pop Smoke from New York. That's his beat in the background. I'm in there. I love
they wrote
hip-hop.
yesterday in a note, economic contraction, stimulus, and central bank balance.
So yes, I'm going to have the most latest hip-hop beats, especially dealing with teenagers. So Bank of America, so both of my videos actually is just focusing on gold now. So let's just talk for a second. So right now, we talked about a few things. We talked about why the oil prices are the way they are. We also talked about things to expect in the next coming months, or what's been going on with the housing market. You please pay attention if you're homeowners, even if you are renting, it affects you because you don't know how your landlord is paying that rent. Especially if you are one of the individuals that couldn't pay rent because of your situation, so definitely keep that in mind. And I think the most important thing to do right now is have open communication with anyone who you're dealing with in commerce, family members, healthcare providers, and everything. So, like, when we talk about commerce, for instance, I was basically um, made aware of. I'm sorry, I got a text that kind of threw me off, but I'm grateful. I got that text. Good morning. Um, So basically, what I have noticed is that, you can take some measures to kind of ease or mitigate some of the hardships of what's going on. What I have noticed most recently, as I mentioned to you guys, who's on my personal page, that, the college savings plan that I had for my kids or have has been losing money consistently, and my college savings right now that I have for both of the kids are not being matched because I am like a traveler, I'm a freelance, so and it's just what I put in. Even though, supposedly the company that I deal with is supposed to match a certain amount, at this point it's supposed to be a certain amount of what you put in versus what the contributions as well of your employee. So I started that with my employee at the time, and I just been keeping it up. So, well, like I said, what I've noticed with, years of contribution is basically that I'm consistently losing money. So in this time, especially where the market is very shifty, this is just what I have chosen to do. What I have chosen to do was to pull all the monies out of my kids' college savings, and I had it distributed to me in a check. And what I won't do is deposit the check. What I'm going to do is hold the check for at least 60 to 90 days because the company that I dealt with, they said within 60 to 90 days, I think it's 60 or 90, that I can redeposit those monies back into the same account and it be active as though the money never was out. So that gives me 3 months or 2 months to literally watch the market and see what's going on before I even decide to put that money back in there if you choose to, especially what's going on right now. That's just what I'm doing because I don't like to take losses. And when I'm giving you money every month into a savings like account, and I'm seeing it's not the fees that's actually losing, it's actually the market, then, you just got to make some changes, got to diversify your portfolio. So with that goes to say, you need to be aware when you already have committed yourself to these college savings plans, 401k plans, and things like that. They come with penalties. They come with tax liabilities as well. So that's why I say you have to really understand what you're doing before you put the money in. I figure with a 10% penalty based on what I took out, I will rather take the 10% initial penalty if I do not put the money back instead of taking a chance and I'm losing more than that 10% in this next couple of months. You know what I'm saying? So these are individual steps that you need to pay attention to, and you possibly want to look at when it comes to your investment tools that you're using. Okay, so the next thing I did too, the housing interest rate, they say, is at a 0%. I mean, well, the federal interest rate is at a 0%, but that doesn't mean that it trickled down to the people specifically like that, depending on your loan company. So one of the things I did notice, I have a fixed mortgage, but my mortgage went up $200. And I'm like, oh, what the hell? What happened? And this was right before the corona hit, and I really didn't appreciate that. So one of the things is you have to be well versed and understand what makes your mortgage goes up, depending if it's the escrow that needs more money because of the taxes or in the insurance, or it's actually your fixed mortgage rate has changed, which caused a change in your mortgage rate, as we talked about that. You think you're into a fixed mortgage rate, but you got this introductory predatory contract that you didn't even read, and 3 years later your interest is just skyrocket to the damn roof. And that's with credit cards and everything. So what that goes to say, I went on a hunt for new car insurance, as well as went on a hunt for new home insurance and tried to look for a bundle pack. One thing I want y'all to be aware of, these companies will lie to you. I had a company specifically tell me last year when I asked about why my home insurance rate went up, right, like a month later, she was like, oh, you can't change your insurance right now because the policy just started, this, that, and the third. Don't let those people lie to you. I was just like, listen, I'm not even going to argue with this lady. I'm going to do what I need to do and change my insurance when I want to, and change your home insurance when you want to. And it's good to pay attention to the market and the best time to do it, especially to the people, shout out to the people who be getting those fake tickets, the ones that the Pope.He be just trying to give because it's time for them to meet their quota. When those tickets starts to drop off of your actual driving profile with the insurance company, be mindful, and that helps you because they probably won't tell you until you're ready to renew. They probably won't tell you at all. So when I went to renew, that was another factor. A ticket from like 4 years ago dropped off of my, so it reduced my insurance rate for car, as well as I come to find out that the home insurance premium rate that I was receiving from this one entity had skyrocketed for no apparent reason, so I was able to get a lower interest rate from another credible insurance agency that that we're able to couple it with with car insurance. So with that goes to say, I need y'all to question everything. It is what it is. I don't care if people be like, oh, you ask these crazy questions. Question everything. So my thing with my insurance company, when I asked them did you determine from last year to this year that it was going to take $199,000 to rebuild my home versus now you say $206,000? And I talked to this representative on the phone, asking them for the mathematical equations. What is it based on? Is it based on supply and demand of certain materials? And this man couldn't answer those questions. I was asking him the shit like he never heard of these type of questions. And that's where we're at. We're in strange times, so I'm going to ask some strange questions, and he wasn't able to produce the facts to me on why my insurance company rolled over a policy that was set into a whole nother different terms, and also, as I mentioned, increase the amount it takes to build my home. So with that goes to say, in later broadcasts, we're going to talk about how to report some of these entities. I have found out a lot of information from the healthcare field as well as from the mortgage sector and also business sectors. When you have these people doing these predatory things or making changes that they cannot articulate the reason why or produce facts behind it, I think you need to report them to other entities to get them put on not only blast, paperwork, as well as show them that us as American people, that we're not going to just settle for things just cause. If you're changing premiums, you're changing certain things, we need to know why. That's my best question. Why? And how is the next question? How did it get done? And if you can't answer that, then we're going to put you on blast. We're going to get someone to review it, and we're going to ask those questions. So that's just one of the things I have done most recently, that I like to share with you guys, because we are all in it to win it, and we need to correct this system. While this system is being disintegrated, this is the best time, not only in the healthcare system, to try to fix the healthcare disparities, but the financial disparities that's going on right now. So like I said, when you have these predatory agreements that has been set up that you didn't know about, and all of a sudden something just changed, you may want to go visit or talk to the Office of Currency Controller. That was some new entity that I found out. The Office of Currency Controller, who the hell? So they all actually have a complaint line. They have a website that you can go on, and if you have certain issues with mortgage companies, loan companies, banks, credit cards, those are the people you need to ask some questions like, wait, why my interest rate went to 1,000%? And it's sad, but like I said, me as a brown melanated person, I'm more gonna go over to that side. I know y'all probably feel uncomfortable sometimes, but I notice subtle changes that happens consistently that I don't think happens with other people. So I want to make sure that everybody's being treated equally. Especially depends on what area you're in. If you're in the South, in the city, everybody plays a different ball game. And you just want to make sure that you are being treated fairly. So I have a list of organizations. If you have any questions, just inbox me. And if I don't know it, I will look it up for you. Because that's just what we do. What else can I say? When we talk about housing and cohabitation, I think it's something that's very important that we need to take in consideration. Some of the things that highlighted right now is the severe issue between relationships of family members, be it kids with mothers, fathers, husband and wives. Like they said, the domestic violence thing has increased. this is a test of time. The coronavirus has tested our patience, our love, and our actually insight of our life, like how things are going at home. Now you realize that, oh, I hate this person. Oh, I can't stand them. Oh, I don't even know my child. Look what my child's into. So this is a double-edged sword, something that we should be able to use as a weapon to correct the future. So my last advice to you guys is definitely, look into finding more cohabitations at this time. If someone wants to give an apartment up that they have, a teenager or a college student, and say, hey, I'm going to move back in for a little while, so some of the money's going towards there can actually go towards this household, and we can try to find a way to practice social distancing. But I think at the end of the day, if you live clean, you clean up behind yourself, with a bleach, ammonia, whatever you need to do, whatever you find that is helpful to, combat this coronavirus, as well as make sure that you're clean, that you're taking your vitamins, you're, trying to build your immunity up. Cohabitation may not be as bad for certain individuals right now. We have to learn to live together to lessen the chance of us actually losing our investment. If anything, it's really hard right now to get up and just sell your house. Who's buying? So that's the other side to the mortgage crisis. When you are acquiring these flip homes, it's hard to sell them in the market right now, as I mentioned. So that is something that we can look at, cohabitation, as well as pooling together and coming up with ideas that we can make money together in a household, period. I always stress to you guys, you cannot leave your family a job. We all supposed to, or play a role in society, which is good to have standard jobs and standard things that production, but something that's within your soul that you love to do, I promise you it will prosper. It may take time, it may take 4 years, few years to even get together, but once you do it step by step, especially in times right now where you're sitting doing nothing, I know a lot of us are investing in alcohol, getting drunk every day because shit just feel crazy. We could take a little bit of that money and put it to the side, maybe diverse our portfolio by, investing in gold, using money to stabilize the economy, using the Fed money to stabilize the economy, and or finding things that we can invest in our community, things that will, prove beneficial in times such as this. One example, well, my son with Shoe Pound Customs, his sales have been going down because we can't go and go get the jeans, the stacked jeans and the things that he do or whatever. And people don't have the money. But what actually happened is that we need masks. So because kids love masks, he has got into that side of the business where he's making masks with matching hats, do-rags, So with that goes to say, you can always make lemons juice out of lemons, orange juice out of oranges, a shit pie out of shit. I'm just saying, you just gotta make it work right now. So I'm gonna end this broadcast. I want to say thank you guys for being with Secure Your Energy. Y'all know I take my breaks off because there's a lot going on. The people on my personal page know exactly where I've been, what's been going on. Check your Nurses to Nurses live broadcast. And we're going to end this broadcast right now, and I'll be coming back maybe in the next 10 to 15 minutes with a focused broadcast on Secure Your Energy, what's going on in the gold market, for the people who have become new Secure Your Energy family members, just to give you the resources that you may need. And we'll just go over basic information and spend a little bit more time with you this Sunday. So anyway, thank you so much for letting Nurse Lashley go over there just talk. And yes, look what the corona did. Now made me put a wig on. Y'all know I don't be wearing wigs. I gotta laugh because people in my family be getting on me because I'm Miss Natural. But I'm like, listen, I'm tired of going around looking like Sugar Bear with my hair braided to the back. So anyway, I love you guys, but we gotta all make the sacrifices. So if I can make the sacrifice, you could too. Many blessings to you guys.